Yeah, so tonight, Castle Condors, 8:30 Eastern. We're going to be taking a look at the March trade, right? We're going to look at the April trade, and we're gonna walk through how you would build a May trade. So, because I have Condors on the mind, I was thinking today we could take a look at why I love Iron Condors and help you understand what is an Iron Condor and why it's a very popular strategy. And I think there's some compelling reasons as to why that's the case. But let me set the table here, Matt. Let's build an Iron Condor real quick and understand what the concept is, and then I'll talk through why it's a compelling type of strategy. Because the options market has dozens and dozens and dozens of option strategies. You can't trade them all. You could, but you probably shouldn't. So most of us, we try this, we try that, and we kind of gravitate towards a strategy that speaks to us. And for multiple reasons, a lot of people end up using condors. So I want to explain, I think, why they are so compelling. Here's the concept. Let's say you have a stock that's $100. Fundamentally, as an options trader, you can buy options or you can sell options. And one way to think about that is when you buy options, you're trying to bet where the market's going to go. I buy calls because I'm bullish and I think the market's going to go up. I buy puts because I'm bearish and I think the market's going to go down. I'm trying to forecast where the market's going to go. When you sell options, you're doing the opposite. First of all, you're selling something that you hope goes down in value, just like a short stock trade. But second of all, for that to happen, I'm essentially betting where the market's not going to go. I'm betting on something not happening. For instance, if this stock's 100 and I don't think it's going to go above 110, I can make money off of that. I can say, let me just sell the 110 call option. Right? I'm going to sell that. I'm going to bring in $1 credit. And as long as we stay below 110, like if the stock goes sideways, the call will expire worthless. I'll pocket the $1. Stock goes down, call expires worthless. I pocket the $1. Stock could go up, but just not above 110. The call will still expire and I pocket the $1. So there's a lot of outcomes where I win. So you can sell calls as a means of betting the market's not going to go too high. But when you sell a call, it's considered a naked call and it's unlimited risk. And so a lot of people don't like to do that. So you can modify the trade and you can make it a limited risk play. You can buy a further out of the money call. Maybe I buy the 115 call and that'll cost you a little bit of money. So it reduces the overall premium or credit you get. Maybe I get 50 cents instead of $1, but the same idea. If the stock goes sideways, up a little, down at all, these calls expire, I keep the 50 cents. So this is a bear call spread. This is a bear call spread. That's going to be part of the Iron Condor, betting the market's not going to go up too much. And it's not that this market has to go dead sideways. I can get a decent sized range that I have the stock trade in and I still end up having a profit. Well, what if you think the stock's not going to go down too much? I mean, could I come in here and sell a 90 put? Sell a 90 put option. You get paid $1. What are you doing? I'm betting the stock's not going down to 90. So the stock can go up, it can go sideways, it can go down a little bit. And in all those outcomes, I still win. The put expires, I pocket the $1. So we sell out of the money puts as a means of betting, getting paid if the market doesn't go down too far. But when you just sell a put, it's considered a naked put. And there's a lot of theoretical risk. So some people don't like that. You can limit the risk. You can buy a further out of the money put. So maybe I buy the 85 put and maybe that costs me a little bit of money. So I give up some of the credit, but I still get, let's say 50 cents total. And so as long as we stay above 90, the puts expire, I make the 50 cents. So that's a bull put. So if you have a directional bias, maybe you do bull puts, maybe you do bear calls, but suppose that you really don't have a strong directional opinion. You just think the market's going to be somewhat range bound. Well, you could do both of these guys. You could do the bull put and the bear call. You could do an 85, 90 bull put and a 110, 115 bear call. And together that creates an Iron Condor. It's nothing more complicated than bull put and bear call at the same time. And the cool thing is you get paid twice as much. I mean, you get the credit on both sides, so you're getting $1 as your potential reward. By the way, the risk, which I don't have time to focus on, is going to be $4 in this case, which is less risky than if you just did the bull put by itself or just the bear call by itself. So you're getting less risk, more reward, but a little bit lower probability. See, when you do both sides, now the stock has to stay between 110 and 85. So it's a narrower range than if you just did one side. Why do I like these? Why do I like this idea? How can I make the case for this type of strategy? The first reason why I like this is because markets, right? So reason number one why I love this strategy, stock prices are mean reverting. They exhibit mean reversion is another way of saying it. They don't go straight up forever. They don't go straight down forever. Typically, they're like a rubber band. If you stretch them too far in one direction, they kind of come back. And so that works to the advantage of an iron condor, because it basically means that if this $100 stock exhibits mean reversion and it goes up too much, it'll probably come back down. And if it goes down too much, it'll probably come back up over time. And so that bias fits nicely with the strategy that profits if the stock stays in a range, right? A good example would be the market right now. I mean, we've dropped a lot, right, over the last bit. And if I can get my ticker right here, and you're seeing a little bit of mean reversion right now, right? Like right here, you had a big drop and then it came back, right? And so the market tends to want to come back to some mean price over time. The other reason why I like this strategy is you don't have to predict direction. Okay, so no predicting direction. Every other strategy, pretty much, has some component of, okay, I'm bullish, I'm bearish. It's nice to have a strategy that doesn't require you to pick a direction, because oftentimes you don't have a strong opinion on the stock price. And maybe you want to rely on other variables to try to make some money. So a third reason that is one of those other variables is we're basically profiting from time decay. Profit from time decay. And so I'm banking more on options decaying as time passes, more than say, oh, the stock's got to go up or the stock's got to go down. Okay. And the fourth and final thing that I'll say in terms of why I love these is you get a profit from options being overpriced, because essentially we're betting the market will move less than expected, less than the options are pricing in. And what's interesting is sometimes the market prices in a lot of movement, sometimes it prices in a little bit of movement, and you can use implied volatility to gauge that. So if you take a look at the VIX, this has been quite high during the last month. And so options have gotten very expensive, and that has worked to the advantage of the iron condor, because we're able to sell really far out of the money options and get a really wide profit range, right? And that is something that really you wouldn't be able to take advantage of unless you knew how to sell options, right? So it's another dynamic that sidesteps directional betting and instead focuses more on, hey, people are fearful. People are paying a lot of money for these out of the money puts, maybe even out of the money calls. Let's capitalize on that by selling the premium. So in that sense, you're kind of like an insurance company. So I could go on for another 3 hours, but those are 4 reasons why I love the iron condor. Those are the assumptions or kind of the rationale that anybody would use when they place these. And that helps you in turn understand when you would do it. When would I do it? Well, when you think the stock's going to be somewhat range bound, when you think options might be overpriced, when you don't have a strong directional opinion. And quite honestly, recently that's worked quite well, because particularly with the Russell 2000 index, which is the one that we've been focusing on for cash flow condors, it's had very mean reverting type of behavior, right? And options have been quite expensive. And even though the market's been crazy, on balance, Russell hasn't gone anywhere for a couple of months. And when it didn't move too far. And so the track record recently has been quite nice. It's not always the case. I mean, sometimes we do lose, but the recent market environment, as frustrating as it's been for short-term directional traders, hasn't been near as difficult for Condor players.